How to avoid Division 293 tax. In this video, I'm going to show you what it is, how to avoid it, the best way to pay it if you cannot avoid it, and my recommendation. Throughout this video, I've included timestamps down below, so if you do want to skip ahead, please feel free to do so. Now, I hope you never get this letter from the tax office, but if you do, my hope for you is after watching this video, you know exactly what to do. Or better yet, this video prompts you to do a little bit of pre-tax planning so you can minimize the tax bill when tax season rings. Hi guys, my name is Susie. Welcome back to my channel. So what is Division 293 tax? Simply put, it is a tax on super in Australia for high income earners. The name comes from the specific section that is Division 293 within the Australian taxation legislation. So I know tax for many people can be such a dry topic. So I will try my best to make it as entertaining and as simple as possible for you. Before we delve further, there are two concepts that you need to be familiar with: concessional pre-tax and non-concessional post-tax. So with concessional super contributions, you pay the lower tax rate of 15%. With the non-concessional or after-tax super, marginal tax rate are slightly higher, anywhere from 21% to 47% if you add the Medicare levy on top. For financial year 2024, i.e. 1 July 2023 to 30 June 2024, if you earn a combined income plus super of more than 250k, you pay an additional 50% on your super. This is in addition to the 15% that you already pay on super, bringing the total tax to 30%. Whoa! Now, one thing I need to point out, you do not pay 30% on the entire super once you exceed the threshold. You only pay the excess amount. Think of this as marginal tax rate. So with marginal tax rate, once you earn above 190k for the year, you don't pay 47% being the top marginal rate on your entire 190k. You only pay 47% on the amount exceeding 190k, hence the term marginal tax rate. If all of that sounds like mumbo jumbo, let me run you through a simple example. So say Bob, So say Bob earned $240,000 for the year and paid $20,000 for super. So that's a combined income of $160,000, which is $10,000 above the threshold. So $10,000 excess Okay, thank you, Google. So 10,000 excess compared to 20k super. The lesser amount is 10,000. You pay 15% additional tax on the 10,000 or 1,500. As you saw from that previous example, there are two variables in the equation: income and super. What is income and super? So these are the examples of income. Your salary, wages are the reportable fringe benefits, capital gain, net rental loss, termination or redundancy payments, etc. And these are the example of pre-tax super. So i.e. employer contributions, salary sacrifice, personal after-tax contributions that you claim the tax deduction on. Now we know what is Division 293 tax and how it is calculated. So the next question is, why do we bother paying this? The reason is this is trying to make it fairer for all Australians across income levels, and ensures that high earners don't receive the excessive tax benefits from their super. But I hear you, for most Australians it seemed anything but fair. It may just be a year where you made a one-off capital gain or received a termination payment on top of all these other taxes that you have to pay, i.e. capital gains tax, etc. You get another hit from this tax on super. In fact, that's how most Australians get caught. It's not something that you and I consciously think about. In fact, people usually find out after the tax return and received what we call a notice of assessment from the tax office. Now, we've covered what is Division 293 tax, how it's calculated, why do we pay it? Well, the next question that comes to mind is, how do we avoid it? The short answer is no. It's not something that you can avoid, unfortunately, even through careful financial planning. And the reason is negatively geared investments such as property and shares, as well as your reportable fringe benefits, are added back to your income to determine whether a Division 293 tax is payable. However, there are things you can do, things like knowing your super contribution caps for the year. You can consider making after-tax contributions, government co-contribution, contributing to your spouse super, especially if they make less than you. And I may add salary sacrifice. Ultimately, paying 30% tax on super is still better off than paying a margin tax rate of 47%. You've come to a point that you understood what is Division 293, why is it charged, how can I avoid it, now it's time to pay. So the question becomes, when and how do I pay? To avoid getting charged interest, which can be quite high, you need to pay by 30 June of each year. There are two ways to pay, either out of your own pocket or release from super. If you have spare cash that you don't need for the immediate future, I would recommend paying it out of your own pocket. Leave your super fund balance intact, as it is an extremely efficient investment vehicle. Most Australians don't have enough super after retirement. However, if you have cash flow issues, I would recommend to release it from your super. The election is actually quite straightforward. You don't need to physically fill out a paper form, although you can if that's your preference. You can simply log on to MyGov, and I'm going to show you exactly what to do. So here is the screen on my iPhone. What you do is you log on to MyGov, select ATO. From link services, click on menu, click on super, and then manage. Select Division 293 tax. So at the time of taking this screenshot, I already released my super. Therefore, on the Division 293 heading, it says no amounts are available to be released. However, it's very straightforward from here on, and you can just elect the amount to release from which super fund. That prompts the question, why bother? Is contributing to super still worth it? The answer is yes, 100%. If you are a high income earner, it is far better to pay 30% on your super than the 40% marginal tax rate. Contributing to super is still one of the most tax efficient planning strategies. Not only do you pay lower taxes when the super enters into your fund, you pay no tax when you withdraw super post-retirement. In summary, we've covered what is Division 293 tax, where does the name come from, how it is calculated, how to avoid it, when and how to pay it, and is it still worth it? I absolutely think that it is still worth it. I hope you learned something. So if you like this video, give it a like and consider subscribing. Love you guys. I'll see you in my next video. Test. Can you hear me? Can you hear me? Test. I can't believe. And I'm not even looking straight at the camera. This whole YouTube thing is so odd. Hi guys, welcome back to my channel. Welcome back. Oh no. What is division? I'm not looking at the camera. Okay.